Hello and welcome to another episode of Darwin Investors. All right, this week we're going to be talking about 5 ETFs that are currently returning more than a 10% annualized dividend yield. We're going to talk about exactly how much they're yielding right this second, what their historical returns have been, and what the holdings are of each of these ETFs that allow them to produce such a generous return for us. And then after that, I'll go ahead and rank my favorites of these 5 ETFs. After that, we'll talk about my current portfolio, how much of this USOI ETN I bought last week, and what I expect to happen to this ETN on Tuesday when the market opens. But before we get into anything like that, let's go ahead and first talk about the basics of dividend investing. And I didn't actually understand the basics of dividend investing prior to like last week, because for me, dividends was something I didn't really pay that much attention to. I didn't really ever buy stocks just for the dividend. Basically, a dividend would be something that would just happen if I owned a stock that I liked, and every now and again it's just going to pay me a little bit of extra money. It's sort of like an ESG rating on a stock. I mean, politicians get all up in arms over this ESG rating, but I don't think very many of us are losing sleep over what our ESG ratings of our stocks are, unless of course you're a politician, and then maybe you are, but most of us don't know and don't care, and that's kind of the way dividends were for me. So let's go ahead and quickly talk about the basics of dividend investing. All right, so this information comes straight from the U.S. Securities and Exchange Commission. It says that when a company declares a dividend, it sets a record date when you must be on the company's books as a shareholder in order to receive the dividend. Once the company sets the record date, the ex-dividend date is set based on stock exchange rules. The ex-dividend date for stocks is usually set 1 business day before the record date. If you purchase a stock on its ex-dividend date or after, you will not receive the next dividend payment. Instead, the seller gets the dividend. If you purchase before the ex-dividend date, then you get the dividend. And then important to note, with a significant dividend, and this one is on USOI, the price of a stock may fall by that amount on the ex-dividend date. So when we look over here at the USOI dividend history, we can see that the pay date is the 27th of February. The record date is the 22nd of February, meaning that the ex-dividend date was 1 business day before the record date on the 21st of February. Now, when we look at this calendar here, the 21st of February, which is the X date for USOI ETN dividend, was on the 21st. So that would say that the day before the X date would be the 20th. However, the stock market is closed on that day due to President's Day. So the 1 business day rule before the 21st was actually yesterday. It was the 17th. So if you didn't own this by yesterday, you're not going to get a dividend by buying it on Tuesday. And that would explain why USOI went up so much yesterday in extended hours trading, because you didn't get this dividend unless you owned it by the end of extended trading hours yesterday. So the stock closed at $83. By the time that extended trading was done, it was up to $84. All this was despite the fact that oil had a really rotten day. This is a 5-day chart of oil. You can see it started around $79 this week and around $76. But you can see there was this huge drop yesterday, and that was due because of a strong dollar. I don't exactly know the relationship between a strong dollar and why WTI crude would trade at such a discount, but apparently there is some sort of relation there. But it was due to a strong dollar and also because of oversupply, and that's today's story. Next week we have an undersupply, but today there was an oversupply, causing the price of WTI crude to plunge. Despite that fact, that WTI crude plunged, USOI still went straight up. And the reason for that had everything to do with this X date and this payment date and the huge dividend. And that's why it charged up. Now, what will we expect from it on Tuesday? Well, we're going to expect that it's going to open really low. No matter how the market is doing, no matter how WTI crude is doing on that day, we would expect that this ETN would open up much lower than $84 on Tuesday because of the large dividend it's about to pay out. All right, now that we've covered the dividend basics, let's go ahead and talk about 5 ETFs that offer more than a 10% yield right now in order to beat inflation. I'll slay the inflation boogeyman in yet another video, but for now we're going to talk about 5 ETFs that offer more than a 10% yield right now. Now, the first of these is going to be JEPI. Now, I've spoken at length on this particular ticker in previous videos. I'll leave a link up there, but we'll go over briefly what this says. And it says, this fund offers an impressive yield surpassing even some junk bond products. That's what makes this one interesting. It's an over an 11% yield. It's a very quality product. It's actively managed by JP Morgan, and so it's backed by JP Morgan. This is a quality product. That's why so many people have flocked to it. Its 30-day SEC yield is more than 11.15%. The 30-day SEC yield shows the dividends and interest earned after expenses. The ETF holds a defensive and dividend-yielding stocks while selling call options on the S&P 500 on a monthly basis. We'll go over more about selling call options later in this video when we discuss a different ticker symbol. JEPI has seen over $14 billion in net inflows over the past year as investors look for ways to offset inflation. It's the largest of the 5 ETFs that showed up on CNBC Pro's screen with more than $20 billion in assets. Again, I've gone over this ETF in detail. I'll go ahead and leave a link up there. If you want to look more into JEPI, please click on that link and you can learn more about this particular product. Now let's talk about some tickers that I've never spoken about on this channel. The first on this list is going to be the WisdomTree Alternative Income Fund, ticker symbol HYIN. WisdomTree has made alternative investments like private equity, private credit, and hedge funds more accessible to investors through its Alternative Income Fund ETF called HYIN. When we see what this is made up of, I don't know why it's a private equity or private credit hedge fund. It doesn't seem to be different than another on this list. However, that is what this claims to be. These historically exclusive assets used to be limited to institutional investors and ultra high net worth individuals due to eligibility requirements, high investment minimum fees, and liquidity issues. So basically, those of us with not, big angel investor type money can suddenly get into this private equity. The ETF tracks the GAP style liquid alternative credit index and has a 30-day SEC yield of 11.33%. The ETF share price has also appreciated by nearly 10% this year. That is true. However, over the past year, it's down 15.7%. The WisdomTree Alternative Income Fund ETF is known as a non-traditional bond by Charles Schwab. It sells right now for $19.55 a share. Year to date, it is up roughly 10%, just like that article said. It does pay right now a monthly dividend of roughly 17 cents a share. It used to pay a quarterly dividend a year ago, but right now it's a monthly dividend. It also has the annual yield of 11.43%, but given in the last year, it's been down 15.7%, we would say over the last year, this particular equity would be down about 4%. But given that the S&P was down like 22% last year, down 4% looks like a pretty good deal. Its last X date was January 25th, so we'd expect its next X date to be roughly February 25th. Last pay date was January 30th, and the dividend payment amount was 17.5 cents. When we look at its holdings, this is what I'm talking about, that I don't know why you'd need to be a private equity investor to get into this. Most of these seem to be mortgage REITs. I don't know if this asset management and custody thing is the reason why, but most of these just look to be REITs. REITs had a rotten year last year. You can see all these minus signs through here. However, they're having a pretty strong year to date by and large. Pretty much all of them right down the line are positive for REITs. And I think that's because the 10-year bond yield has been coming down, mortgage rates have been coming down, and people have been investing in REITs thinking that the real estate market is turning the corner. It's only got about 25 holdings, the largest of which is this Angel Oak Mortgage Incorporated. You can see it's got Redwood Trust, Chimera, Rhythm Capital, Hercules, Ares Capital, Arbor Realty, and the like. Some of the other holdings in this ETF are going to be Main Street Capital, Ready Capital, Starwood Property, Apollo Commercial, MFA, Blackstone, Annaly, and Ladder. So if you believe that the 10-year is going to be continuing to come down, or perhaps there's going to be a pause in interest rate hikes, or that you think the real estate market is going to be staying hot for the rest of the year, HYIN might be one to consider. But for me personally, I kind of am going to just rank it behind JEPI. So I had to put JPI 1, this one 2 for now. So let's look at the next one on the list. So the next one that we're going to talk about on this list is the VanEck Mortgage REIT Income ETF, ticker symbol MORT. So it's going to be the second in a series of these mortgage REITs that seem to be appearing on this list. The reason why mortgage REITs are appearing on this list is because the risk-free rate of return on mortgages is going down. People are more interested in buying real estate this year because this year relative to last year, mortgage rates are coming down. Plus, it's believed that the Fed is going to be kind of coming to the end of its tightening cycle, at least relative to raising interest rates, making real estate a more attractive investment this year than it was last year. But last year was not as good as the year before when we had 0% interest rates. And so for that reason, these REITs are doing really well this year, but not doing so well last year. So the rise in risk-free rates led to the dramatic re-rating of real estate investment trusts in 2022. This means that REITs today offer new investors significantly higher yields than they did this time last year. VanEck's MORT fund is one such ETF offering a 30-day SEC yield of 11.91%. The index tracker fund holds the largest and most liquid companies in the U.S. mortgage REIT sector that drive at least 50% of their revenues from mortgages. So let's go ahead and have a deeper look at this VanEck Mortgage REIT Income ETF. The VanEck Mortgage REIT Income ETF is selling for $13.07 a share. Year to date, it is up 9.92%, similar to the other mortgage REIT. However, over the course of 1 year, it's down 20%. Over the course of 3 years, it's down 42%. And over the course of 5 years, it's down 40%. We can see that it pays a quarterly dividend, unlike the other one that paid a monthly dividend. This looks to be, let's call it 35 cents, maybe even 40, we'll call it 40 cents a share over a quarter. So monthly, that would be about 12 cents a share. And giving us an SEC yield of 11.98%. The last X date was December 28th. The last pay date was December 30th. It would mean that the next X date might be like March 28th. That's what we would expect. When we look at its holdings, it's going to have a whole lot of mortgage REITs, just like HYIN had a bunch of mortgage REITs in it. However, it's got a large percentage of its assets in this Annaly Capital Management. It also has Starwood, it has Rhythm, it has Arbor, Blackstone, Camara. So there are some similarities between this one and the last one. It has 26 holdings. The last one had 25 holdings. The last one had some other type of holdings. This one seems to be exclusively mortgage REITs. It also owns Ladder, Two Harbors, Franklin, New York Mortgage, so on and so on. Again, because REITs are doing well this year, this equity or this ETF seems to be doing well this year. With an 11.9% dividend return over the past year, this one's down about 8.9%. I would say that because the other one pays out monthly, even though this SEC yield is a little bit higher on the VanEck, I would say because the other one pays out monthly and hasn't lost as much money over the past year, I would give the edge to HYIN over this MORT, just because of the frequency of the dividend and because that it doesn't seem to have lost as much money in the last year or really over time in general. So I would have to put this one third behind JEPI and HYIN. Let's go ahead and take a look at the next one. So the next one on this list is going to be the Bond Blocks CCC rated USD high yield corporate bond ETF, ticker symbol XCCC. I'm laughing because it's CCC rated. So these are like really, this is a junk bond ETF of some of the worst companies with respect to credit. To give you an example here, Microsoft is AAA rated, as would be like Johnson & Johnson, or really any company that you would see in the S&P 500 would have like at least an A rating. And this is taking all those away. We want CCC or worse. All right, so investors willing to accept higher risk might find Bond Blocks' XCCC attractive. The ETF tracks the ICE, B of A, CCC, and lower. Remember, CCC is the ceiling. You can go down from there, apparently. U.S. High Yield Constrained Index, and currently offers a 30-day SEC yield of 13.26%. That's really good. The fund invests in bonds rated CCC1 and lower on average by 3 major rating agencies. The below junk credit rating means bond issuers pay high interest to borrow but are often at risk of default. Now, right now, people aren't defaulting on loans, business aren't, and just people borrowing on credit aren't, and people can't figure out why, but it has to do with the high rate of savings people have now relative to 2019. We still have savings. No one's really defaulting on our loans. But the fund does manage to minimize risk by capping exposure to any single issuer at 2% of the fund. Let's have a better look at this ETF. The Bond Blocks CCC rated USD High Yield Corporate Bond ETF sells for $37.09 a share. It's down 7.85% over 1 year. However, I think it said it was 13.65%. We'll be the judge of that over the course of a year. So right now it's actually up 6%. Year to date, it's up 4.46%, but overall, this junk bond ETF is actually up 6% over a year, considering the S&P was down 22% last year. That was really good. Over 3 years, it's down 8.79%, and over 5 years, it's down 8.75%. So let's go ahead and look at this yield here, because right now the distribution yield is not listed here. It does pay monthly. The last X date was the 1st. The last pay date was the 7th. It paid 37 cents a share. So let's see what the annual yield is for this thing. So if you have $10,000 and you divide that by $37.99, that would mean that you have 263 shares of this. If you multiply that by, say, 0.38, we'll say, that's what it pays out a month, then we're going to have $100 a month. You multiply that by 12, then we're going to have $1,200 a year. You divide that again by the 10,000 that we started with. It would mean that the annual yield would be roughly 12%. So they were saying 13, and I'm getting 12. It all depends. Do we say it's 38 cents a share? Do we say it's 40 cents a share? But all in all, the 13% seems to hold some water. So let's go ahead and look at the holdings of this ETF. It looks like it's holding on to some companies I've just never heard. Well, McAfee I've heard of. That dude's not, that might be trouble. Veracast, B-Way, Altice, Allied. It's got 211 holdings. It's got an awful lot. So that's what they mean. Nothing over 2%. As a matter of fact, if you go here, the biggest holding is 1.5%. It actually goes down from there. You got Carvana at 1%. That could go bankrupt. But so you're going to have a lot of these CCC rated companies and lower in this. However, what I do like about this company is, or this ETF, is that it does seem to pay a dividend yield that exceeds its losses. It does so year after year. It seems to be on the up and on the way up this year as people really are defaulting on their loans. I think this looks like a really promising, nice ETF, and it pays out a great dividend. I would have to say, in my opinion, this one would probably maybe go to the top of the list, maybe second, right behind JEPI. I would say this Bond Blocks XCCC would probably be 1 or 2 on this list. I wouldn't mind getting into this one at all. And in fact, I might just do something like that here at the end of this month. We'll see what happens with my current holdings in USOI. So let's go ahead and look at the final one. The last ETF on this list is another one actively managed by JP Morgan. It's the ticker symbol JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. It's sort of like the NASDAQ answer to the JEPI, which is the covered call ETF on the S&P 500. The JP Morgan NASDAQ Equity Premium Income ETF appears to be a riskier alternative to the defensive-leaning JEPI. JP Morgan says the JEPQ fund generates income by selling options as well as investing in U.S. large-cap growth stocks in the NASDAQ 100. The actively managed ETF has delivered returns linked to the index, but with less volatility in 2022, and that makes sense because the JEPI has less volatility than the S&P 500. If the S&P 500 goes up 5%, we'll say in a day, JEPI will only go up about 2.5%. However, if the S&P 500 goes down 5%, JEPI will only go down about 2.5%. This NASDAQ Equity Premium ETF seems to do the same thing for the NASDAQ that JEPI does for the S&P, so it's less volatile than the NASDAQ. However, you're not going to get all those returns on the way up. Reason for that is because they're selling calls against that index. The fund currently offers an SEC yield of 15.67%. Hamilton Reiner, he's a portfolio manager at JP Morgan for 14 years. He manages both the JEPQ and JEPI ETFs. So let's go ahead and look at what a covered call is really quick, and then we'll look at what this ETF is. So here's an example of what a covered call is on one of my own personal holdings, which would be ConocoPhillips. So when you go over here, you type in COP, which is the ticker symbol for ConocoPhillips, you select call. I say that I'm going to sell to open one call on ConocoPhillips. One call is 100 shares. Each contract is 100 shares. It has a termination date, it's got a strike price, and it's got a premium that you collect. Let's say that I want to sell this a little bit out of the money. Let's say a $108 strike price. They're going to give me 50 cents a share, or they're going to give me what amounts to $50 a contract. So what this says is that if ConocoPhillips finishes above $108 by the 24th of February, I'm still on the hook to sell ConocoPhillips to the buyer for $108 a share. Even if this is $110 a share, someone's paying me $50 to hold on to this contract. However, if ConocoPhillips is only, say, $102 on the 24th of February, I get to keep all my shares of ConocoPhillips and I get to keep their money. And that's the deal that we're making as a buyer and a seller. And that's what a covered call is. And that's what JEPQ is doing to the NASDAQ 100. And the reason why I didn't show you the NASDAQ was because they're funny, because when you look at the dates for the NASDAQ, this thing basically has dates that terminate pretty much every single day of the week. And this is really unusual that this can happen. But these guys are selling weekly options against the triple Qs. But that's what they're doing. They're saying that we're going to take this triple Q and we're going to sell to open one contract that expires sometime next week. We'll call it the 24th, and we're going to collect $372. But that's what this guy is actively managing, the assets that are in the portfolio. Plus, he's selling covered calls against the triple Qs here. JEPQ looks to be kind of a high flyer here. We're at $43.12 a share. Over the course of 1 year, it's down 15.61%. I don't know how old it is. I guess it is. It came about here in 2022 is what it looks like. Yeah, so it's a pretty new ETF. Over the course of its lifetime, it's down 12.38%. This year to date, it's up 6%. It does pay that 15.67% annual distribution yield that's distributed monthly. It has the same pay date as JEPI. It's going to be the first of every single month is when it goes X. So you want to be in it before the last day of the previous month if you want to collect the dividend from this. Over the past year, we can see that the dividends look like it's roughly 44, 58, 55. So we'll call it 55 cents a share, maybe 40 cents a share. Last month, a lot less. So right now, while the NASDAQ is running pretty hot, it looks like the dividends around 55 cents a share. But when it's running cold, it looks to be about 38 cents a share. The equities in this ETF more or less mimic the NASDAQ 100. You know, there's some changes though. He's actively managing it. And so the Microsoft would be the biggest of the assets here at 10.15%. Apple is second big at 9.35. If it was going according to the NASDAQ 100, Apple would be the biggest. So he is actively managing this, but it does seem to hold pretty true to the NASDAQ in general. So it appears it's got 77 holdings. On the second page, we would have Analog Devices, Netflix, Booking, Intuit, Qualcomm, Synopsys, Broadcom, Costco. It does have, like we said, some covered call holdings against the triple Qs. It's only got 5, meaning he's actually kind of bullish. He doesn't want to sell a lot of calls right now against the NASDAQ. I don't know how many calls he's got open against the S&P 500 right now, but I believe it is more than 5. So the return on this is over the past year looks to be pretty even. This looks to be fairly low risk. I would have to say for my risk appetite, I would put this one behind the junk bond one, believe it or not, and I would put behind JEPI, but I'm not a very risky person. But again, this is a really nice one. And its dividend yield looks to be about 15.67%. So I really do like this one. I think there's a big difference between this one and the one that I would put forth on the list would be the HYIN. I like this one a lot more. So I would probably go JEPI and XCCC would be kind of tied 1 and 1A. And then this one would be next. And then a large step down from that be HYIN. And then I wouldn't even bother with that final one, which was MORT. Now let's go ahead and look at my own personal portfolio and what I've been getting into. So when we look at my portfolio here, pretty much all I own is oil and gas stocks. I own a Tesla and nothing but oil and gas stocks. All right, so what I did buy was I bought a whole lot of USOI last week. Last week it closed at $83. I'm down $671. I have 650 shares, so you can kind of figure that I've got it for about $84 a share. Now on Tuesday when the market opens, because when dividends go X, on that date, everything pulls way back, I would expect that I'm going to lose an awful lot of money on the underlying of USOI when the market opens on Tuesday. So if I had been up, let's say $750 or even $800 on this, let's say that oil was up last Friday from some kind of oil shortage type of news and it went up on that day and I was up $800, I would never see that dividend because I take that money as fast as I can get it. It's just who I am. I'm never going to make life-changing money in the market because I take money as fast as I can get it. It's just who I am. Can't help it. Might be why I'm so good at options. Like if I had just done options last year rather than hold stocks, I'd have made so much money because as soon as I get up like 50%, 60% on these covered calls or selling puts or whatever, I just take the money. I don't wait around to lose the money. I take it when they give it to me.
It's mine, you understand? Mine, all mine. Get back in there. Down, down, down. Go, go, go. Mine, mine, mine.
And so on that note, I have 2 puts that I have that are open right now. I've sold a put on Chevron. I've sold a put on ExxonMobil. I actually own Chevron as a stock. And, you know, just for S's and G's, let's just go ahead and see what the what is that called? The ESG rating is on Chevron. So Chevron, which is an equity that I own, I go down here to the Morningstar report. I click on the report. I go over here and it looks like the ESG rating on Chevron is 2 out of 5. That's shocking. I would have thought it was more because really, I mean, you want to keep the price of these oil stocks low. And the reason why is because if you make it affordable for a lot of these emerging nations to be able to buy oil and gas, maybe they wouldn't have to burn coal. So in my opinion, the ESG rating on Chevron should be like a full-blown 5. They got it at 2. What do they know? Well, anyway, that's going to do it for this week, folks. That's 5 ETFs that yield over 10%. If you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.
I'm rich. I'm a happy miser.